And the most common mistake is people underestimate how much they would need at retirement. So think about it, right? So I'll just give us a quick example here. Just think about how much you would need to have if this was your requirement, right? Let's say, for example, you need 150,000 a month, which is equivalent today, in today's terms, in 20 years' time, right? So it can increase based on inflation and so on. But to live a comfortable life, you feel that 150,000 rupees today is good enough as my living expenses. Just an example, right? If inflation was 6% and the returns that you're making on an after-tax basis was 8%, how much monthly do you need to contribute now to achieve that 150,000 equivalent return in 20 years' time, right? And this is without affecting the principal that you're accumulating in 20 years' time. Just if you're assuming that you're going to live with your return that you're making on the investment portfolio, right? So to summarize, if you're going to live a life which is, your expenditure is going to be 150,000 a month, equivalent of today, in 20 years' time, with an inflation of 6% and a return of 8%, how much do you think you need to save today to achieve that 150,000 goal in 20 years' time? Just think about numbers, right? So first, to derive what you need, right? First figure out what your future monthly savings will be or spending will be, right? So to calculate your future monthly spending, you look at your current spending, which you think is 150,000, grow that by inflation over the number of years of retirement, right? So in our case, this will be 150,000 into 6% inflation to the power 20 years. And the compounding effect will mean that you need to have 481,000 rupees a month to cover for your expenses 20 years down the line, right? So that's the monthly expenditure need in 20 years' time. Second, if you need 481,000, how much of assets or how much of lump sum money that you need to have? So to calculate this, what we do is we take the 481,000, which is the future value of the monthly spending. That's for a month. So we multiply it by 12. And that has to contribute in terms of return. So we divide it by the investment return, right? So 8% has to give you that 481,000 rupees, which means that you need to have 72 million rupees in your account in 20 years' time to hit that 150,000 goal in 20 years' time, right? So it's a fairly large chunk of money when you look at it that way. And if you translate this into today's terms, if you start today, how much you need to save now, we can do an annuity calculation where you take the lump sum payments, take the monthly return. So if it's 8% annual return, you divide it by 12 and take the number of months retirement. If it's 20 years, it's going to be 240 months. You work out the calculation and you need to be saving 121,000 rupees right now if you are to make 150,000 equivalent retirement spending in 20 years' time, right? It's a fairly substantial amount when you look at it that way, right? So this is assuming that you're not going to use the capital that you will accumulate in the future, but assuming that you're going to use the returns to finance your in 20 years' time, right? So which is why it's a substantial amount, right? And you need to start saving now to get to this point in 20 years' time. And in this entire equation, the interest rate or the return that you make plays a critical role.